Hey everyone, happy Friday, September 27, 2024. I'm Phil Hodgen, and welcome to the Hodgen Law PC International Tax Lunch. We do this almost every month on the last Friday of the month at noon Pacific time. You can listen in online where you are right now, or later we pop the video onto YouTube and you can watch it there. This month is going to be the sixth and final episode of the FIRPTA series that I've been doing. And it's going to be a walk through a typical sort of what a transaction looks like for a non-resident owned California house that they've always used just for personal purposes, hadn't been rented out. Fairly typical transaction. By foreign owned, I mean a non-resident alien, to use the vernacular. I don't mean somebody who's living in Delaware and has a California house. So here we go. And I will, some of this will be normal for those of you who are in California and who've seen California real estate transactions go by, but I'll sort of try to explain for those of you who are outside of California, how things work. At least LA County, Southern California. I mean, statewide, it's more or less the same, but I will tell you this. And this is basically anonymized versions of a few transactions that we've done fairly recently. So this is real world. So here we are, the final episode. Next month is going to be an expatriation explanation for tax returns and Form 854, and then we're going to launch into a series on foreign trusts. So this wraps up the FIRPTA series. And your handy-dandy table of contents, introduction. You can see what the biggest, hardest problem is in California and indeed all real estate sales, which is the FIRPTA withholding. What do you do about it? And the conclusion. So let's start here with the intro. What's within your control? What isn't? This is the good old, the Stoics, the serenity prayer, right? You pay attention to what you can control and just, slough off the rest as best you can. So what is within your control? So you, metaphorically speaking, the seller, or you, the tax advisor to the seller. Well, the first item that is within your control is the FIRPTA withholding, federal withholding on sale of U.S. real property interest by a non-resident individual or a foreign corporation. And today I'm talking about, let me start the clock here. I'm talking about an individual seller rather than a corporate seller, with one exception, which you'll see later. So the FIRPTA withholding, this is section 1445A, says, when a foreign person sells U.S. real property interest, the buyer must withhold 15% of gross proceeds of sale, send the money to the IRS, and then the seller files a U.S. income tax return, reports the sale, calculates the actual capital gain, and gets a refund of the excess. So anyway, so this is as a non-resident is exiting the U.S. market, the government wants to make sure that the tax liability, whatever it is paid. And so the withholding is imposed at the moment of sale, and everything is trued up later when the actual tax return is filed by the seller. That's what it is. So there are three ways you can deal with it. One is acceptance, right? Okay, fine, take the 15%, I'll file a tax return and I'll wait forever for my refund. The next one is reduce, where there is a procedure, and I'll describe it in a while, where you can ask the IRS to reduce the required withholding from 15% of gross to a number that's calculated equal to the estimated capital gain tax on the sale. And the third one is your strategy is to eliminate FIRPTA withholding entirely. And how do you do that? Well, FIRPTA withholding is required when there's a foreign seller. So you quickly do some, card shuffling, and magic presto, you have a domestic seller. Domestic sellers do not have FIRPTA withholding problems. Therefore, you carry on. You pay your estimated tax, you file your tax return. So the government gets their money eventually, but they just don't get it in a giant lump up front. So how does it work? The FIRPTA withholding, the sale closes in normal fashion. 15% is withheld on behalf of the buyer. Remember, the buyer is the withholding agent, technically, but there will be some intermediaries in the transaction that actually do this work. And in the case of transactions in Southern California, at least, it's an escrow company, a sort of neutral company that handles all the paperwork, receives the cash from the buyer, and then when everything on the checklist is complete, the escrow company will have the grant deed recorded. The seller gets what the seller wants. I mean, the buyer gets what the buyer wants, which is the property, and decants the cash out to the seller, which is what the seller wants. Funds are remitted to the IRS. I think it's either 20 or 21 or 22 days after the closing. The money has to be sent off to the IRS with Form 8288 and some other crap like that. So the money goes, and then now it sits on as a credit in the system for the seller, waiting for the tax return. Usually this, as you might guess, is going to be a considerably more money than the actual tax liability, because 15% of the gross sale price is usually a much larger number than 20% of the net capital gain. So the second strategy is reduce FIRPTA withholding with a withholding certificate. I'll talk more about this in the future, so this is just sort of an overview in the intro. But you file this form 8288B and basically give the government everything. You calculate your capital gain, you give them backup documents for basis. It's just insane. You send this thing in before the closing date. You tell the escrow company, hey, I've made an application for reduced withholding. The escrow company says, gotcha, sir. And they hold the 15% at the escrow company in a little segregated account for your benefit, earning a little bit of interest. And then eventually the IRS will respond to the Form 8288B that you sent in. They'll send back this letter, and I'll show you an example of what one of these looks like later in the slide deck. And the IRS says, we agree, your actual withholding required is X, whatever that X is, which is less than 15% of gross. The escrow company sends the X dollars to the IRS, with the withholding tax, and sends the rest of the money left in this little segregated account off to you with some interest. And now you're done. Then the seller files a tax return, got some money on credit, withholding tax against the capital gain tax liability. And in theory, on the 1040 NR, tax withheld equal to or greater than or approximately in the same neighborhood of the actual tax liability on that final tax return. The final one that I have in my kit, so full 15% or at the other extreme, 0% withholding, is by creating a domestic seller. And the typical way I do this is by forming a new C Corp, California Corporation. Sometimes I'll do an LLC, slot the LLC onto title months ahead of time, and then use a check the box selection to flip the single member LLC from disregarded status to C Corp status. And do that effective date will be just slightly before the sale is consummated. What that does is now you say, who is the seller here, who's entitled to the proceeds of sale? And it's a domestic C corporation. Domestic corporations and domestic taxpayers of all kind are exempt from FIRPTA withholding. So now you're done. The cash goes into the California corporation. California corporation, depending on how fast it moves and what the time of day is going to make an estimated payment or just file its final tax return and be done and pay the tax, and now you're gone. And then later you do a liquidating distribution of the cash left over and you send it upstream to the non-resident individual shareholder offshore. The typical reason you would not have a sort of long-term structure like this, non-resident alien owns a domestic corporation, owns U.S. real estate, is because it doesn't protect it against estate tax. But here we have like a window of 6 weeks or 8 weeks or something like that, in which we have technical exposure to estate tax. And in fact, you had it anyway already. So it's a no big deal. The likelihood of your seller falling over dead in the time from signing a contract for sale until the sale is over is trivial. I mean, it could happen, but we'll see. So anyway, so that's what you're going to wrestle with as the big conundrum for yourself, and you'll have the discussions, and I'm going to get into detail on more of that. The tax compliance that you face will be a function of the FIRPTA withholding strategy that you choose. So you can see from simple, right? You just file a 1040 NR and the California 540 NR. I'm going to put a dash in there. I mean, this is dumb. The non-resident return for an individual is dash 10 NR. For California, it's no dash NR. Whatever. And so I get it wrong all the time. Except, so you file your 540 NR and your 1040 NR. You have the 15% withheld on the federal return. You get a refund eventually. The middle one, the manage it, where you do the withholding certificate, you're still going to have to file a tax return for the year sale anyway. But in this case, you're going to also do this form 8288B, which is the application for reduced withholding. So that's the paperwork. The final one, it looks like a metric ton of paperwork, but I guarantee you by the time you add on an extra 1120 Form 100 with California corporate tax return, the 5472 and 1042S for the liquidating distribution, it ain't going to be that much more work than going through the withholding certificate application. So it looks bad, but it isn't. In the case of the domestic, you slot a California corporation in to eliminate the FIRPTA withholding because you have a domestic seller. Regs 1.351-3 say that when there's a 351 transaction, which is what this is, you have to, the person contributing the capital to the corporation has to file a 1040 a tax return to report what's happening. So you still have a tax return technically for the individual. So that's what you have going on. Tax rate comparison. Federal tax rate, no big deal, right? Individual long-term capital tax rate at 20%. Corporate tax rate currently at 21%, no big deal. Just so you have it, it's not on this slide, but a non-resident alien individual is not subject to net investment income tax, the 3.8% on top, and therefore does not pay it. So in fact, capital gain, if you're a non-resident alien investor in U.S. real estate, economically, you're a little bit better off than a U.S. citizen investor. So there you are. California tax is kind of interesting. The income is income, and we have a graduated tax rate up to infinity. And you reach the 9.3% individual tax rate at round number 68,000. And that bracket, the marginal tax bracket, runs up to 350,000. Well, it's not too difficult to have long-term capital gain of 68 to 350,000. In fact, it's frequent to have capital gain well in excess of that. And then, above the 9.3 is 10.3, and it goes up and up. Compare this to the flat corporate tax rate of 8.84%. There's actually a little bit of state income tax saving arbitrage here. And if you have a giant transaction, it may be worth your while to save some state income tax by ratcheting down to the 8.84% corporate tax rate. But anyway, so this is what you have to work with as you're trying to decide, is it worth telling my client, hey, let's do this complicated thing and make a corporation have fun? And they'll look at you like they've been hit over the head with a baseball bat and not understand what you're talking about. But that's what it'll be. All right, so that's FIRPTA, and I'm going to talk about that again more, but it's a mess, and it's going to take some actual hard work by you. What is not hard work? California withholding. So California also has withholding imposed on real estate transactions at the time of sale. It is basically unavoidable. Well, if you slot the corporation in, a California corporation is exempt from withholding, so you save that. But for normal circumstances, there are two choices, and you get to go with the one that you want. One is either 3 1/3% of the gross proceeds of sale, or the second one, if you want to go that way, is 12.3% of the computed capital gain. So you see here, it's mimicking the methodology that is used for federal withholding, right? 15% of gross proceeds for federal, or file form 8288B, wait a long time and we'll tell you the magic number that you can have as a reduced amount of withholding, which is a function of your capital gain tax. Here, California just makes it a lot simpler and just says, choose which one way you want to go. And I'll walk you through this form in a little bit. But this is form 593. You're going to fill it in. You're going to give it to the escrow company. You choose the withholding that you want to have, and there will be a number. And the escrow company will withhold the tax, remit it to the franchise tax board, send the 593 to the franchise tax board, give you copies, blah, 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 and you're done. Easy. All right. So those are the two things that you're going to have to be working with and thinking about as the tax professional in one of these sales. But let's talk about just the transaction itself and what is not within your control. And the reason it's not within your control is because it is highly standardized in this kind of real estate transaction in California. So the California Association of Realtors has pre-printed forms for almost everything. And brokerage firms will have pre-printed forms for a lot of stuff. And escrow forms will have pre-printed generic forms for all of the transaction documents too. These are basically non-negotiable. I mean, you can negotiate the commission you're going to pay and all of that sort of stuff, but this is what is used. And it makes a transaction very predictable in terms of the paperwork and very predictable in terms of understanding what's done. If there's an inspection period, there's a checkbox and you fill in the number of days, right? And things like this. So it's very clean. So you're going to see a whole bunch of these forms go by that you have no control over. They're just transaction forms. They govern the agreement between the buyer and the seller. There's disclosures and blah, blah, blah. And they're just going to go through. The only documents that you are likely, as the tax advisor in one of these transactions, likely to be asked to help with will be this thing called a certificate of non-foreign status, which is for federal tax withholding purposes. You're declaring, I am a domestic taxpayer or I am not a domestic taxpayer. And if I am not a domestic taxpayer, 15% withholding is going to happen unless you do this withholding certificate form 8288B scenario that I'm going to highly recommend that you avoid. And you'll be asked to do the form 593, and you'll see in a bit there's a part of form 593 where you calculate actual capital gain, acquisition price, adjusted basis, blah, blah, blah. So those are the only two things that you as the tax advisor are probably going to be asked to talk about. So here's the list. From start to finish, there's a standard form listing agreement that your seller will sign with the brokerage firm. The brokerage will also have a bunch of their own riders that go along with. If you look at the listing agreement and you look at all the riders from the brokerage firm, what you're really seeing is the sediment of 50 years of litigation. So every time a transaction went sideways and some disgruntled buyer or disgruntled seller kicked up a snit and filed a lawsuit, whack, another disclosure form, another waiver goes into this thing, another paragraph into the standard form. So it's just a bunch of BS, but there it is. It's all there to protect the broker. Next, you're going to add the property will be listed for sale, and buyers will erupt out of the ground and come flinging money at you. They will come with a standard form offer. from California Association of Realtors form that'll detail the terms of the deal that the buyer wants. And then there are little one-pager documents for counteroffers, back and forth and back and forth and back and forth. So the seller will get an offer, not like the price that's being offered, not like this, not like that. And we'll counter offer and we'll say, I agree with your offer, except for paragraph 2. I want this price instead of that price. Paragraph 12, no, you can't have 1,000,000 years to do your inspection, blah, blah, blah. And then the counter offers go back and forth like a ping pong game until everybody agrees that all of those open loops on the offer counter offer sequence have been agreed to, at which point the last person on that sequence, when the ping pong ball goes to their side of the table, said, well, it looks good to me. They sign off. And now you have a document with both the buyer and the seller on it. You take those documents and they go to an escrow company. The escrow company will say, yes, I will agree to be your middleman, hold the money, collect all the documents, do all the stuff. Please sign my standard forms. And so you do that. And now you're off to the races. You have a deal. And as soon as the escrow is opened, everybody gets to work. And the typical things that everybody gets to work on will be inspections. And so there will be a whole raft, again, of seller disclosures that the seller has to give to the buyer, ranging from the supremely stupid, you're buying a house in a known place that has earthquakes. So I know, right? Stuff like that. And you'll go back and forth. There will be back and forth. The inspection will inevitably bring to the surface something wrong with the building, and there'll be a price concession or this and that. And that will become a contract amendment and all of this. And that'll all happen. All of this is going to be on pre-printed standard form kind of things. So I know this sounds weird to those of you on the East Coast where everything is handled by lawyers, but none of this is handled by lawyers, nor is it needed, really. I mean, in giant transaction, yeah, but on a normal single family resident, no way. So that's what's going to happen. That's the contract of sale, the legal document by which you give me money, I give you a house. Tax forms, certificate of non-foreign status, you will be asked for that. That's a pre-printed form. You'll either fill it in or not, depending on what the correct answers are. Form 593, California withholding, you'll help fill that in to select and ensure the right amount of withholding is done. And then the grant deed. The grant deed is frequently one of the more problematic pieces of the equation, because if your seller is outside the United States, a grant needs to be in recordable form. Otherwise, the recorder's office will bounce it. In order for it to be recordable, it needs to be acknowledged. That's code word for notarized or an apostille. And if you have somebody overseas, how do you get a document notarized? Well, one way is, there we go. So the practical problems. One way of doing this is there's this process called an apostille. I think in 35 years of doing this, I've had one success with apostilles, and otherwise it's just been supreme brain damage, and I've just conceded reality and sent the seller to the nearest consulate or embassy. So try it if you want, but if not, send them to the nearest U.S. embassy where they have a notary and things get notarized. There is the possibility of remote notaries, and I've seen this from time to time, and it's extremely useful. So you talk to the title insurance company to see what they will work with and what they will not, because the title insurance company is really the final arbiter, because if they say it's recordable, it's recordable. And what I've seen is that if the seller is a U.S. person, meaning got a passport or a green card, then a remote notary is possible. What I have seen is that if the seller is not a U.S. citizen, not a green card holder, they're sitting somewhere outside the United States, remote notary will not work. So this is a transactional question. Maybe it'll work for you, maybe it won't, but that's my experience anyway. I have the bullet point at the top. Of course, you need an ITIN if you've got a foreign seller, and I hope you have an ITIN already. Um, for those of you who practice in this area, you know the fun and games of trying to get an ITIN issued for a non-resident individual. It's a bit of a pain. All right, so with that introduction, let's go into the deep parts. The primarily I want to talk to you about FIRPTA withholding, picking a strategy and implementing that strategy. So again, we have the three methodologies, the accept, reduce, or eliminate. And what we're really talking about is you're going to do a rough calculation and say, what's my expected refund? And then you're going to say, what's the expected value if I put that refund in a bank account for the seller today versus I wait to file a tax return and then wait 6 months or so for the IRS to actually send a refund check. What's the lost interest or lost investment returns on that refund because it's not in the seller's pocket? So, overly simple example. Let's just pretend we have $1 million sale price and 200,000 long-term capital gain on this house. 15% withholding is going to be 150,000 withholding required unless we do something about it. 20% federal tax rate times 200,000 actual capital gain is $40,000 of actual expected capital gain tax. Therefore, we have a refund of 110,000. Okay, well, that 110,000 is going to be somewhere. It's going to be sitting in the IRS's bank account, waiting for a tax return and an eventual refund. It's going to be sitting, if you use the Form 8288B process, in a bank account at the escrow company, earning some interest for your benefit until the IRS issues a withholding certificate, or the 110,000 is going to be in the seller's pocket now, and they can do whatever they want with it. So using 5% because it's approximately what T-bills are. This little example, you say you sell early in the year, February 1. You really get on it. You got a filing deadline of June 15, 2025, but you're on it. You get that tax return filed February 1. All right, so that's 12 months of waiting. I forget where it is, but I've seen it a number of times as bemused me, where the government says, I think it's in the 1040 NR instructions. If you've got withholding on a foreign real estate transaction, expect us to take about 6 months to issue a refund. So I'm going to use 6 months for that. So that takes us out to October 1 from the time they receive the 1040 NR on February 1. Right? So you got 18 months. 18 months of 110,000, 5% interest rate. That's $8,200 of lost interest income. All right. It's money. It's not big money, but it's money. And the question is, what are you going to do about it? Are you going to try and capture some of that economic value, or are you just going to concede it and go accept reality the way it is? Now, note Internal Revenue Code 6611E. This is the interest on overpayments. The rule is that interest starts accruing. The government has 45 days after the filing deadline, so June 15, 2025 in my example. And if they issue a refund within that 45 days, they don't have to pay interest, but otherwise they have to start paying interest. So in my little example where I said October 1, in fact, you might get a little bit of interest starting July 1 or July 31, until the refund is actually sent out on October 1, which will offset some of the 8,250 of lost interest income, but not all of it. So this is the economic model that you will be playing with when you're trying to advise the client about, what do I want to do? Do I want to just take my 15% and I'll file a tax return next year, and I'll wait until I'll get a paper check, and I'll take my paper check to my bank in Saudi Arabia, and it'll take 6 weeks for the bank to process it. It'll ultimately be up to the client. And that's really what it is. What I've seen in this situation is sometimes it's the economic reality of the loss, the opportunity cost of not having the money in your pocket. But more often, there are two sort of non-present value, future value factors going on. One of which is they come from a country where they really don't trust the government to issue refunds. If money falls into the well in their government, in their country, it's gone. And so they deeply distrust the US government and they don't think they'll get their money back from the US government. My experience is every time you're going to get the refund. It may take a while, but you'll get it. The second one is that the seller may really need the money. And this is, translated to finance language, this is the discount rate, right? And I use 5% as my calculation. Well, what if they really need it because they need capital for their business or there's some other burning emergency at home? They may be willing to pay extra money to expedite the refund in some fashion. So be sensitive to those kind of needs and see whether those are at play. But otherwise, what you're really doing is calculating that lost interest cost on the expected refund. So let's walk through the details here. This is the do nothing, just sell, take 15%, please, and I'll get it later. This is triggered by the certificate of non-foreign status. That's going to be one of the documents in the standard kit of forms that you sign for the escrow company. So if the seller is a foreign seller and you've got this form that says, I certify that I'm not a foreign seller, well, the easy way to deal with this is you just tell the escrow officer, I ain't selling, right? And then they know, I ain't signing this thing. So they know then, well, I have a foreign seller. Therefore, as the withholding agent's agent, because the escrow company is sort of standing in and doing all the mechanical work for the true withholding agent, which is the buyer, they know I have to take 15%, remit it to the government. So that's easy peasy in terms of dealing with it. Eventually, you will get, or the taxpayer will get, one of these forms, Form 8288-A, specifically copy B. And you see in the bottom right-hand corner, there's a stamp, and copy B as mailed, and that's the IRS stamped that on the piece of paper. The little black box of redaction at the top right-hand corner is the IRS wrote this long string of numbers, which is a tracking number for their purposes. And the other redacted stuff is just information about the taxpayer that I just took out, and the address is our old address. Which I kind of highly recommend that you do this, because the last thing you want to do is have the IRS sending stuff to a post office box or an address somewhere overseas, and hopefully you get it. This is a real problem. I once had a California tax refund that kept sending it to Mexico, and we had 3 successive checks just disappear, and it took 18 months to finally get it straightened out. So do not don't trust the post office in any country. But anyway, so this is it. You're going to need this to prove to the government on the 1040 NR that you actually had tax withheld. In this particular case, we had to bird dog the hell out of this thing in order to get the 8288A out of the Internal Revenue Service so we could file the tax return for the seller. So this transaction happened in February of 2022, and you'll note that the mailing date for this cover letter from the government with the Form 8288-A is August 2023. This is not unusual. My experience with the FIRPTA unit, I have no good things to say about the FIRPTA unit, and so let's just leave it at that. So that's what you're going to get. I know, going back to this Form 8288A, if you don't have that, or if your seller didn't have an ITIN when it went in, and therefore the government doesn't know that this $472,500 belongs to you, it's just sort of floating loose in their bank account, You run a real risk of filing a 1040 NR saying, hey, I have 472,500 of tax withheld to offset my tax liability to you. And the IRS comes back and says, oh, no, you don't. Please pay the tax, and we deny that we have your money. And then hilarity ensues. So this is a really important form for you to get. But having said that, let's contrast it to the way that the California withholding process works. The California withholding, this is the form, the top of the form is Form 593. The California Franchise Tax Board, it pains me to say this, but they are clear-minded saints. They have developed a process that works easy and cheaply and effectively. So God bless them. I don't know. I mean, that's where my tax dollars go, to people like who have developed systems like this. All right. Aside from all of that political ranting that you just got from me, here's how it works with the California withholding. Immediately below the name and address and all that fun stuff, you have this part 3. And the part 3 is, am I exempt at all from the California withholding? Well, you see here, I've pointed to box 3. If you have a loss, or at least no gain, then there's no withholding required. Glory be to God, right? And you'll fill in something on the next page, and I'll show you where you prove to the Franchise Tax Board that you have no gain or loss. You sign the certification, and you're done. So that's the primary exemption that you're going to find. The other one that you're going to see is if you look at 6 and 7, where you have a California corporation, or at least a corporation that's registered with the Secretary of State in California, or line 7, a partnership, you can exempt yourself from this Form 593 withholding. Because what happens is then the withholding obligation is just passed downstream to the entity. So, but you eliminate this problem. But we're back to this where we have a human as a seller. So we've picked line 3 because there's an exemption, and you're going to fill in the selling price, expenses, basis, blah, 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 blah. And line 28, you're going to have estimated gain or loss on the sale. If line 28 is 0 or negative number, then you just skip over and carry on and certify on page 3, and withholding is not required. So easy. Okay, so that's the loss or no gain scenario, California. Note, by contrast, the IRS system would require you to have 15% withheld on the gross and get everything refunded to you whenever you've got a refund on your tax return, or would require you to go through the Form 8288B process and request withholding be reset to 0. So much better this way. Now let's look at this as you have a gain, right? You're going to be selling at a gain. So some withholding is going to be required. How do you handle it? Well, part 4, box 12, you check that. There are no exemptions possible, so I'm in withholding territory, and you move on to the next page. And here again is the computation. And we're either going to use this computation for what's called the alternative withholding calculation, which is magic words for I would like you to withhold at 12.3% of my actual capital gain calculated, or you do it for the 0 situation that I just described. So because almost always, but not always, it's going to be better for you to have 12.3% of capital gain withheld rather than 3.33% of the gross sale price withheld. You're going to be filling this in. And again, you just give the Franchise Tax Board the numbers. And then once you've done that, you flip over to the next page. And here you choose, what do you want to do? You check the box individual, 12.3%, and you're going to multiply your capital gain by 12.3% put it on line 29. And Line 30 is the 3.33% withholding. So now you have these two numbers in front of you, and you can choose the lower one that you want. And then finally, in this part 7, this is where you declare which of the two withholding methods you want to have applied. So line 36, you see here, box A is the 3.33% of sale price. And box B, in our case, an individual seller, 12.3% times gain on sale. And you put the right number, and off you go. So here is an example. So that one that I gave you, the withholding certificate, the 8288A for that sale. Here is what we did for the Form 593. So the sale was at 2.85 million. You see blah, 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 blah. Line 28 down, the seller had 838,960 of capital gain. Lines 29 and 30, we show the relative values here. What is the withholding amount with 12.3% on line 29? 103,192. And paradoxically and unusually, the withholding, if we did 3.33% of gross, is 94,905. So of course we picked the lower of the two. And just so you can see the excerpt from this seller's Form 540 NR, you see on line 74, this turned out to be his actual tax liability after all the hoo-ha and deductions and whatnot, quite separate from the 593 calculations. So he had a California tax liability of 85,143. You see on line 83, the actual tax withheld on Form 593 of 94,905, which ended up line 201 at the bottom, overpaid tax of $9,762. So that's how it worked in real life. And, he got a paper check. We mailed it off to him in Saudi Arabia. In due course, he cashed the check after grumbling. Why can't they do a wire transfer to me? Well, because it's the government. So that's the California thing. And I want you to keep this model in mind. All we had to do was give the Franchise Tax Board the numbers, just like you would on a regular income tax return. I certify under penalty of perjury, these numbers are correct. You just gave them the numbers, and we calculated the tax. We came up with a withholding number, a high low. We picked the low, done. Now let's go look at the IRS. This is the withholding certificate procedure with Form 8288B. So what you have here in the IRS procedure is the default 15% is withheld unless the IRS gives you explicit permission to have lower withholding. And since the withholding risk is on the buyer has no incentive to do anything except withhold the 15% unless the buyer is actually holding a piece of paper from the IRS that says something different. So the buyer is always going to withhold the 15% unless you go through this process. And here's what a withholding certificate looks like. You would hope that it would be a glorious certificate, printed in color and with gold banners and stuff like that, but no, it's just a computer-generated letter. And you get this in due course after you've sent in your whole package to the IRS, to the FIRPTA unit. They've lost it. You've called. You've sent another one to them. They've lost it. You called. They found it. And then they've said you're in the queue and you'll hear from us in a year. I'm not exaggerating. I want you to look at this. So I hope the numbers are big enough. See in the big paragraph below the redacted one, says the 7,925,000, 7,925,000 was the sale price for this house. Look how they put 7,925,000 as the tax liability. I don't know how the hell that happened, but we did not complain because you look on the third line to the right, The required withholding on this, because the capital gain was not all that much, was $9,089. And so the withholding certificate, which we gave to the escrow company, authorized the escrow company to remit $9,089 to the IRS and send the remainder of the cash to the seller who was in the UK. So you see on the bullet points on the left where I've given you the calculations, we had a sale price of 7.925 million. So the initial withholding and 1.188750, that sat in an account at the escrow company, earning interest at a paltry amount, like a 1% or something silly like that. But at least it was something for a long, long time. So this is what it is. The other thing I want you to note is look at the date of the withholding certificate here, February of 2024. The sale happened in October of 2022. So here's the withholding. This is what we're going to do. You're going to start with this form. In contrast to the Form 593, which is 3 pages and it's all you need, this is 1 page, but it's one of these iceberg IRS forms where the form itself is seemingly very simple, but by the time you do all of the off the form homework and bolt on everything, most of the work is hidden from view beneath the surface of the ocean. The relevant rules for this, Rev Proc 2000-35, and then I've given you the citation to the certificates, to the regs that say, hey, withholding agent, I know that you're supposed to remit money to the IRS within 20 days of the sale, but you can hold on to it if you have noticed that the withholding certificate process is going on, and you can hold on the money in your own bank account until you hear from us, the IRS. So this is the hall pass that lets the money sit in the escrow account rather than sit in the United States Treasury. And Rev Proc 2000-35 gives you the nitty-gritty mechanical details of how this works. And you'll have a little side agreement with the escrow company that they'll agree to hold your money for you pending the release of the money. So here, in a nutshell, this is your bet, right? I've got 2 red lines here. On the left, you can see when does the excess withholding, the expected refund, get decanted out to you and who's in control of it. So you see on the left, FIRPTA withholding, you start within escrow, gross sales proceeds, the cash from the buyer comes in. They carve off 15% of gross proceeds and they send it immediately to the Internal Revenue Service or within 20 days of closing. With the remaining 85%, they pay the other sales expenses and then send the net proceeds to the seller. You wait, and then you file a Form 1040-NR. You can see that the amount of withholding hits the Form 1040-NR on line 25F. So that's where you tell the government that this is how much money is sitting in your account to be applied to this taxpayer's actual tax liability. In due course, they process the 1040-NR. The tax liability is the tax liability, and they refund the excess, this remainder amount, to the seller. So what you're betting on here is the time for processing a tax return and a refund and sending it to the seller. Strategy number 2 on the right, this is the withholding certificate process. And in this case, the 15% is withheld and held in an account at the escrow company, waiting for the withholding certificate. And you wait, wait, wait. And then as soon as the withholding certificate is issued, the escrow company wires the money. In my experience, it usually happens in 48 hours. So that's really the thing. You're asking, will it be faster for the government to process the Form 8288B, or will it be faster for the government to process the Form 1040-NR and send a refund? Up until the last few years, I mean, it was starting to get sucky pre-COVID, but COVID threw everything off. Um, you would expect the government to process the 8288B a lot faster than getting the tax refund issued. No longer true. So more about that in a second. So I'm going to show you the little excerpts from the 8288B and how it works. And keep in your mind comparison to the Form 593. So here, 8288B, why should you get a withholding certificate? And 7B says, my tax liability is less the amount of tax required to be withheld. So that's going to be the usual situation. What do you have to do for line 7B to prove it? You are giving the government the full calculation. So line 1, you're going to give them the contract of sale in the current transaction that's going through. Pardon me, line 7B, item 1 under those in the instructions. Item 2, evidence of adjusted basis. So you're going to have to dig up the closing statement for the purchase. You're going to have to get all of the capital improvements documented. You're going to have to give full depreciation schedules, blah, 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 so that the government can document the estimated capital gain. Contrast this to the Franchise Tax Board in Form 593. They just say, what's your adjusted basis? So we had one about a year ago where it was a very large house in a very expensive part of LA, and they'd probably put 25 million into capital improvements to make this thing a very nice house indeed. And the documentation for 24 months worth of construction, as you can imagine, was batshit insane. So, you will be doing an enormous amount of work here. And so when I said before, you might think that Form 8288B is less than preparing, forming a California corporation, transferring as, blah, 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 the eliminate, maybe not. Anyway, you'll go through this whole process. You'll send in the whole package to the IRS, Form 8288B, with the desired number for the withholding. My experience is that you should absolutely not do the Form 8288B, the end. You will be well in excess of a year if they don't lose anything. They lose stuff. And your opportunity cost, if you say, for somebody who had a lot of money on the line, for instance, $35 million sale, think of the lost opportunity cost for T-bill interest on that money all the time while the government is trying to process this Form 8288B. So my strong recommendation is that you do not ever utter those words 8288B. The Internal Revenue Code says that these things must be processed within 90 days. If you read the regs and you read the various administrative pronouncements that the IRS has made about this process, they give themselves a hall pass to wildly violate the congressional instruction here. And so it's useless. They don't take them seriously, and I don't see why we should take them seriously either. So this is one of the rare instances in which state government does supremely better job than the Internal Revenue Service. So don't do this. All right, enough of that. Let's move on to happy stuff, the FIRPTA withholding strategy, which is eliminate withholding entirely. So the base of this strategy is that only foreign sellers have withholding, so we are going to not have a foreign seller. It's as simple in concept. It's a Section 351 capital contribution to a California corporation. There's a bunch of paperwork that's required to make sure this is a non-recognition transaction, but it will be a non-recognition transaction. The domestic seller then sells the real estate. Since it's domestic seller, it will sign, well, the officer will sign the certificate of non-foreign status. I am a California corporation, and be done with it. So there will be no FIRPTA withholding. And for that matter, there will be no California withholding either because the California corporation is exempt from with the Form 593 withholding. The other cool thing about this is, let's say you have a seller that doesn't have an ITIN. You make a real estate transfer from the non-resident alien seller grant deed into the California corporation. That's not a tax transaction, so the LA County recorder is not going to require any kind of tax ID number. Yeah, technically there is a FIRPTA withholding problem and all of that, but you're going to deal with that at year end when the individual finally files the Form 1040-NR to report the capital contribution. So what this means is that if you are in a time crunch, getting the house out of a human's name into a corporation, you can get an EIN online for your corporation. You can get it, you're in business and you can get this transaction closed. Later, you'll catch up and you'll apply for, you've attached the Form W7 to the 1040-NR that's filed, and everything will work out in the long run. Anyway, but that's the idea. Here is an example of how I do it with an LLC. And I do it with an LLC because I want to wait for as long as possible until I know I have a deal in the bag before I trigger C Corp status and we start to have all the C Corp compliance requirements. So step one, put it into a disregarded entity, California LLC, drop it in, easy grant deed from the individual to the LLC. This also means that you can appoint another manager who's not the non-resident alien individual, but who may be local in Southern California or wherever it is, to sign the grant deed on behalf of the LLC, which is convenient. At some point, you're going to have a contract. You're going to make a Form 8832 check the box election as step two with an effective date like a few weeks before the contract sign. And then you're going to go through the whole transaction. And I show you here the transaction. There will be a sale. You're going to end up at step 6. The pre-tax cash is in the C corporation. You're either going to make an estimated tax payment on behalf of the C Corp, or you're going to just file your final tax return. I've shown this broken up into 2 fiscal years, where the first fiscal year for the C corporation starts on the effective date of the check the box election. But what's the closing date of this first fiscal year? And I'll pick a date like an end of month, let's say a month or 6 weeks after the sale is complete. And that way I've got the whole sale on one Form 1120 and Form 100. So that's there and it pays the tax. And then I still have a corporation that's alive, and I adopt the liquidation plan. And the second fiscal year shows the liquidation of this thing with the liquidating distribution and everything gone. But it all happens within just a few months of calendar time. And then once everything is done, you dissolve the LLC and it's gone. You can dissolve the LLC earlier if you want. There's a provision in California Corporations Code that says a company that's dissolved, LLCs or corporations, the officers still have power even after the formal dissolution for the orderly windup of the corporate affairs. And so, this LLC and its agents or officers or managers would still be able to do stuff if you wanted to. But I find it convenient to have the entity alive until I know I don't need it anymore. So here's a little example of the economic value for large refunds, where you can see this starts to make a lot of difference. So if you have an expected tax refund of $1 million and 5% interest for 12 months, that's $50,000. That's worth working for, as compared to a small refund of 100,000 where 5,000 is really not worth it. And similarly, where you have transactions early in the year, this procedure that I'm talking about, eliminating withholding entirely, is often a lot better than transactions late in the year, because if you have a transaction closing in January or February, you have to wait a long time until the following calendar year when the forms become available so you can file a tax return for that um, transaction that happened in January or February. And so all of that time, you can cut it short by putting the asset inside a corporation, electing a short fiscal year, liquidating it, and be done with it. So this is just a way to sort of calculate a value and communicate the value to the client when you're trying to explain to them, maybe this is the way to do it. Okay, if I were you, I would, we do this kind of transaction a lot. And here's how the economics I do it. It's easy for you to say, well, how much will it cost me to form a corporation? How much does it cost me to do a corporate tax return? How much does it do? You know, the different elements of the tax compliance game. But what you chronically misunderstand is the amount of fiddly stuff that you have to do in between just to make all the pieces move. So I would do, if you want to give a budget to your client, estimate what it would take for all of the visible steps that you can see, double it, or maybe 2.5 it, and say, this is the budget. And so if you can say to a client, it's going to cost you $15,000 for all of this extra BS that I'm going to do, but I'm going to capture you $50,000 in money, you know, the interest that you could earn on this money. So, you know, here it's worth it. You want to go for it. And the client, the seller will say yes or no, but at least you do it like that. My gut feeling is I'm going to strongly recommend this for someone if I can see a 3x payoff for every X dollar that they pay us for overhead for doing this process. I want to see $3 in their pocket, or you know, the accelerated interest on this refund. So that's the way I do this kind of stuff. There we go. Conclusion. For those of you who are not in California, you'll find that California real estate transactions are easy peasy as a transactional matter. You'll find that the California withholding, as you see on Form 593, is easy peasy. You just calculate it and go, and you file the tax return later. The FIRPTA withholding is a giant pain in the neck, and if you have a transaction early in the year or a very large transaction, then it really makes sense to think about dropping the property into a California C corporation. I would not, under any circumstances, ever apply for a withholding certificate until you've seen evidence that the government has changed its course, but I don't expect that anytime soon. There we go. Thank you for sitting through the 6 months of FIRPTA stuff. Email me if you have any questions, comments, suggestions. Next month, October 25, 2024, the International Tax Lunch will be an expatriation project. It will be a hands-on preparing an expatriation year income tax return, and specifically Form 8854. Deborah Rudd in our office will be doing that. She's done dozens, if not hundreds. I mean, well, in excess of 100. We've done a lot of these things. And so she'll be talking to you about that, how to do it, her experience, you know, where you can stub your toe and stuff like that. If you're watching this online and you're not on our mailing list, please sign up. Just go to internationaltaxlaw.com and there'll be a place for you to sign up and get this. And I will be back in November, starting with a 4-episode series on foreign trusts. Thanks so much. We are done, and back to you, Elaine.